Ken Range Theory Trader back with you with another video going over the weekend review. So we're doing things a little differently because while we're still focusing on candle 3, we're really just trying to get consistent wins with a 1-to-1 risk to reward ratio on the bottom half of candle 1. So I'm going to go through the just one for each day. This isn't all the ones that played out, but these are quite a few of the ones that played out on the 8-hour chart. So first off, we'll start with Monday. It was pound CAD. So I'll just mark the bias side since we're really not worried about the other side of the range. So this was the low on the 8-hour chart on Monday. So Monday, see the 1700 candle was candle 1. Candle 2 was this long candle here. It went down, closed inside the range. So candle 3 started at 9 a.m. Eastern Standard Time. So when we go to our replay option, what we do, select the bar. What we do is, in order to ascertain our trading zone, we use a fib and we draw it from candle 1's high to its low, like that. Okay, I'm going to get rid of this just so it's a little cleaner. And then the only thing we're doing is looking for fair value gaps in candle 3. And we're using a 1-to-1 risk to reward ratio in order to increase our chances of profitability. So if I drop down to the 5-minute chart, those are all the trades that we take. That's the time frame we take our trades on. It's 5 minute. And turn on my fair value gap indicator here. We see there was a gap. Sometimes when the candle opens, it'll retrace into a gap. So your best entry would have been, it's already here at 9:05. There's a gap that's already present. So you could hop into this. And let me see, I'd recommend either doing a 20 pip stop loss, 20 pip take profit, or 30 and 30, either way. But it's still going to be decent regardless of which one you use for the most part. So 20 and 20, obviously this one you would have been out in like 5 minutes, as you can see. But the reason that we do this is because when you have a tight stop, sometimes, let's say for instance, if you went here, this is the main reason I switched to 1-to-1s and doing it like this. See, if you base it off a fair value gap, for the most part, it's going to avoid stuff like this. Let's say you have a real tight stop like that, like 6 pips right here. See, because the price retraced into this gap. See this candle right here? Let me make it real big so you can see. See this candle right here? I wicked through the gap and then came up. It would have stopped you out of a valid trade. Okay, for example. So I use 1-to-1 in order to just increase our profitability, and as well, we don't let it hit the stop loss as well. That's going to help you to control risk, because if you set it and then let's say the gap disappears, if I set a price alert, you set like a price alert right here, and you see if a candle will close outside of the gap, that will erase it. Then you just go ahead and exit the trade and don't even let it hit your stop loss. So, I prefer the fair value gap method for setting stop losses. It's with plenty of breathing room, so you avoid stuff like this right here. Okay, don't make it so tight that you get stopped out, but don't make the take profit so large that you're sitting in consolidation for hours. So you'll know pretty quickly whether you got a winner or not when you're trading 1-to-1s. So that's that. So this was a pound CAD. So like I said, it was 9:05 was the entry. It really would have hit in 5 minutes. At the latest, you would have been out by 9:45. Okay, so if this didn't get you out. So that was Monday's price action. So let me go to the next one, which was pound yen short at 5 o'clock. So we'll go to the 8-hour. Okay, I'm gonna go pound yen. Replay option. I think this is it right here. Yeah. So I'll mark the high right here. Remember that I like to see candle 2 making the high of the day, or if it's going into the next day, the high of the prior day. So this was the high of the prior day right here, candle 2. So then we just look for those fair value gaps in or above candle 3. I'm sorry, candle 1. One thing that I would recommend, don't trade outside of the range. Look for the first fair value gap inside of the range. Don't trade up here, because I've seen it break out of the range and keep right on going. So safest bet is to just wait for price to come back inside the range and make a fair value gap there. So let's drop down to the 5 minute and see where that gap is. Remember, this was at 1700, so we do wait for the spread to calm down like around 6 or so. So we notice price is outside of the range up here, so we're not trading that. When price comes back inside the range right here, this is at 9 o'clock p.m. Eastern Standard Time. This is a sizable fair value gap. So let's see, we could do a short, and we could have got in right at 9 o'clock. Let me see if a 30-30 would have been fine. Yeah, and could have did a 30 for 30. And again, say if you're risking 10%, you could have got 10% on this trade, done deal. Okay, in a fairly short order. So you would have been in at 9, trade paid out by midnight, a little after midnight. So that would have been fine there. So that was that one. And it was, we already know it's above the middle of candle 1 since it's so close to the range high. So we'll get rid of that. Go back to the 8 hour. And let's see what was Wednesday. Wednesday was New Zealand dollar at 1 a.m. It's rare I trade 1 a.m. Really, I'm trading at like 1700 or 9. I really don't do 1 because I'm trying not to trade 24/7. But let's see, New Zealand dollar. So 1 on Wednesday. Okay, so this one was a little different because it consolidated, but I'll show you how candle 1's low did hold up and how it still would have been a valid trade. Let me get rid of these fair value gaps so we don't get confused. So here's the deal. Candle 1 is right here. So we draw our fib. Candle 2 is right here at 9 o'clock a.m. Eastern Standard Time. That was on Tuesday. So going into Wednesday, okay, we have a long bias. So we either could have taken something in the 1700 hour or also in the 1 o'clock hour. So you kind of had two chances. So I really based it on the 1 o'clock hour. So let's go down to that one because price was still below the purple line. As long as price is below the purple line, this is our trading zone right here. When it's above it, I don't tend to trade that because sometimes price will come back to you. So your highest probability is going to be from the range low to the middle of the range. That's where we aim for 1-to-1s, not 1-to-5, not 1-to-7, just straight up 1-to-1s. So see, we drop down. Let me find the 1 o'clock open price. It was right here. Okay, so this candle right here opened at 1 o'clock. Okay, see how it's below the line? So we're still below the middle of the range. So as soon as price created this first fair value gap here, you had two chances. You could have got in, let's see, about right here on the line for a 1-to-1. And let's say with New Zealand, I would have did a 20-20 because it's not very volatile. Lower ADR pairs would be fine. So your entry would have been at like 1:30 a.m. You would have been done by 5:05. Okay, so there you go. Good, good return on that one. Very little drawdown. You also had a second chance to get in around 4 because this fair value gap still held. So as long as the gap holds, I consider the trade to be valid. So two chances to get in that one, but there you go. Quick 1-to-1, 20 pip top stop loss, 20 pip take profit. Easy enough. So the one for Thursday was pound CAD long at 9. So we'll go back to the 8 hour. I think I took this trade too. Yeah, I did. Turn that off. Okay. All right. So pound CAD at 9. And let me show you another beautiful thing about using the 1-to-1s. So here we go. Candle 1 was at 5, candle 2 at 1. So here's our 9 o'clock trading candle for candle 3. So we just draw our fib. Okay, we've established our trading zone. So we're looking for fair value gaps below the middle of candle 1. That's it. Anywhere in here, we are free to trade. So let's drop down to the 5-minute. And let's see what the first gap is starting at 9. It might have retraced into 1. Sometimes 9 o'clock, remember, will retrace into 1, and it did that. So your perfect entry would have been anywhere from like 9:50, 9:55, 10 o'clock, anywhere in there. you could have done as far as stop loss and take profit. Like let's just say we get in here, pound CAD, I'll do 30-30, like that. And I mean, not very long at all. You could have got in at 950. You would have been done by 1035. Okay. Could have got a 10% return, 20% return, whatever your risk would have been. $100, risk 100, make 100. Okay. This risk 1,000, make 1,000. Either way, this is all you're looking for right here. Yes, we know it went further. I understand that. But let me show you the beauty of one-to-ones as well. Let's just say, you know what? Well, I want to get, like say a 1-to-5. So let me adjust this. All right, there we go. That's a little over 5. So let's see if the 1-to-5 would have hit. And I'm going to speed this up. Okay, notice. Look at what price is doing. It already hit the candle range high. Everybody who wanted a 1-to-5, it's not going so well for them. A little bit of pullback, and then more drops. And that would have been a stop out right here. That's the live chart right there, at least. Okay, so take what you can get is my point. See that? Anybody who wants those high risk, high reward trades, 1-to-5, 1-to-4, even a 1-to-4, did it make that? No, it did not. All right. If you do 1-to-ones, I promise you'll see more consistency. I promise. There's a reason why I'm switching and I'm going against what I used to teach before. Okay. That's not to say you can't get 1-to-5s every now and then, but every single day, it's not happening. Okay. It's not going to happen. But you can get at least 1-to-1 a day. You won't win all of them, but you can get one a day. I promise you that. Just trading candle threes. Even if it's not the real candle three and the price comes back on you, if you just get a piece of the market of what you think could be a candle three and stick to the range I'm showing you, you'll do better than most people. All right, so the last one that was pound CAD. This was a Euro Aussie, so I took this trade today as well. So let's take a look at it. And this was another one too that actually came back, if I'm not mistaken. But reset that. Yeah, it did come back. So I was glad I got my piece and got out. So, okay, so this is the live chart right now because today is Friday. Candle 1, 1700. Candle 2, 1 a.m. So then candle 3. Now it was green, but now it's red because it hit the candle range high and then it came back. So, but this is just the same 3 candle pattern over and over. So I was long because price swept this candle's low, closed back inside of it. But notice I'm not trading above the line. Remember, I only trade below the middle of candle 1. That's it. So let's go down. And this one was a little different. I actually shot a trade review on it because I used an internal or inverse fair value gap to take the entry. But I'll show you that now on this, but I'm going to have to do a replay. So let me see. Yeah, let's see. I think it was somewhere in here. And then show the IFVGs. Was it over here? I'm not exactly sure. Or maybe it was this one. I'm really not sure. It might have been a different one. But in any event, let's just go what we see because I don't see the inverse fair value gap, but at the same time, I do see a real one. So this will be just as fine. So let me just switch to regular fair value gap so there's no confusion. Okay, so the first fair value gap, let's just take our time with this one. Okay, so you come to the chart, right? You come to the chart, you're waiting for your first fair value gap. There's a red one here, but your bias is long, so you're just waiting. Because fair value gap, you consider that to be momentum. So you're waiting, you're waiting, you're waiting. Oh, there it is right there. Okay, see that little tiny gap. This right here is your signal. So you got candle 1, candle 2, candle 3. When candle 3 closes and that makes the fair value gap, that is your entry for this model. Right there. Risk to reward could have been, you could have did a 20-20. So you would have got in at 10.50. All right, on that one. Okay, as long as this gap holds, the trade is valid. So now let's see if we're in at 10.50. How long does it take for our TP to get hit? 5, 10, 15, about 20 minutes. Okay, that's it. That's it. You can do this over and over and over again. The main thing is going to be controlling your risk and not getting greedy. If you get 1 to 2 a day, be happy with that. Don't try to get 5, 6, 7. Okay, that over trading thing it hurts me, and I know it hurts other people as well. Just because okay, I can do 1-to-1 and just trade all day, every day. Just take what you can get. Be happy with what the market gives you, and then find something else to do. Okay, but that was it. So first fair value gap below the line. I mean, it doesn't get any more simple than that. All right, so that was what a perfect week would have looked like. So hope you guys get some value out of that. I appreciate your time and attention. Thank you for watching, and have a great rest of your day. Take care.